There's only 50 accounting principles. And what the allowance method is you estimate how much your bad debt expense is in the same period you made the sale. Okay? So you guess. You guess. This is one of the estimates. Financial statements are not really what happened to a company. It's an estimate of what happened to a company. I'm not kidding. Right? That's it. That's all we got is an estimate. So what we're going to do is we're going to debit bad debt expense and credit the allowance. Okay? For our estimate of what we're not going to get paid. Okay? Why do we do this? Really important to understand why. Because then you can sort of get your head around why you're bothering with this and how to do it for that matter. Okay? Why do we use debit, bad debt expense, and credit allowance? Why do we credit allowance instead of crediting accounts receivable? Why don't we just take them out of accounts receivable? The reason I want to debit bad debt expense in the period I recorded the sale is what? Tell me that. What do you want to do? You want to get what? You just read about it in the last chapter. What do you want to do? And early on we did too. We want to get the revenues recorded in the period that we earned them, and we want to get all the costs associated with those revenues matched with them, right? Expense recognition. We want to get them recorded when? In the same period that the revenues were earned. Why do you have bad debts? If I sold 100,000 on account, and I think some of them are going to be bad. You know, if I sell to the general public, some of them are going to be bad, guys. If I sell to businesses, some of them are going to be bad. It's going to happen, right? It's a cost of doing business. Otherwise, don't sell an account. Require cash. By the way, why doesn't everybody just require cash? A lot of people do. Why don't we do that? Because you might not sell as much. If you don't give people credit, they might not buy as much from you. So in order to get more sales, I grant credit, right? So I have accounts receivable. But when I grant credit, what's a possibility? In fact, a likelihood, a probability. I'm going to have bad debts. So I am accepting bad debts when I grant credit, right? I am. And I can estimate pretty well. Companies get pretty good at estimating how much they're ever going to collect. 1% of their sales, 0.5% of their sales, 2% of their sales. I'm not kidding, right? And by the way, those of us who do pay get to pay more for all those deadbeats that don't pay. You like that? Fun, huh? That's like when people tell me that they don't pay their income taxes. I get really outraged. Don't brag to me about not paying your income taxes. Why? I pay mine. I have to pay more if you don't pay yours. You thief. You're stealing from me and then telling me about it? Thanks a lot. That's great. So what I tell them is I'm a CPA. So I'm ethically bound. You call the IRS and tell them their name, then quit talking to me. They're fucked up our ears of it. I'm lying. I can't call the IRS and tell them that. Ethically bound, not. They're not my client, really, but not what. But you can. Go to your CPA, right? Go ahead. Turn them in those fees, right? You go out. They're paying, steal from you. You have to pay them taxes because they don't pay theirs. Not okay. So anytime somebody doesn't pay the receivable, right? Typically, though, people don't pay it because they go bankrupt. They didn't pay it and they go bankrupt. Well, that one we can live with. That's just a normal course of business thing. That happens. But if they bought it knowing they weren't going to pay for it, they just stole it, right? Stole the product. But anyway, when should you record that expense? Pretty obvious, huh? In the same period you record the sale. When do you record the sale? Now. When do you find out they're not going to pay you? Probably not until much later. Probably a year from now. What do you bet? What do you bet keep trying to collect for a year on open account receivable? You give them 30 days to pay, what do you bet you'd wait a full year before you gave up? Right? Probably would. So we're not going to get the bad debt expense recorded in the same period we have the sale unless we estimate the bad debt expense. That's all we're doing. Everybody got it? Okay? So on the income statement, I want the sales recorded when I earned them, and I want all the expenses recorded in the period that I earned the sales. So I'm going to put the bad debt expense in the same period, right? Estimate. On the balance sheet, what do I want to show? I don't want to show people how much is owed to me. I want to show people how much I think I'm going to collect. What we're trying to do is predict future cash flows for the company, right? So we're going to use these financial statements for is to predict the timing, when, the amount, how much, right? And the uncertainty of future cash flows. And that's how we're going to value businesses, okay? Those of you who are not accounting majors in DA 315, you're going to learn how to actually value companies using discounted present value, basically, is what it is. We estimate the cash flows, how much risky they are, right? And then we use that to value companies. That's how we value things. By the way, that's how UPS values an airplane. How much they're going to pay for an airplane when they buy one. What they do is they predict all the future cash that's going to come in from that airplane, from hauling freight with it, all the cash that's going to go out for everything related to that airplane, like paying for it, maintaining it, fuel for it, right? Everything related to, the pilots and people loading it, everything, okay? Fuel. Everything that you do, everything that they do related to that airplane, they guess what the cash flows are going to be. How much? So it's net positive cash flow, of course, they would buy the airplane, right? More comes in than goes out. And then they're also going to guess when it's happening, and they're going to guess how risky it is, right? And then they're going to discount all those cash flows back down. You guys know how to discount that? You know about time value of money? You do, right? In a math class somewhere you did it, you discounted future cash flows. You know how to compound, you know how to compute interest and compound interest on interest going forward. Discounting is the reverse of that, which is taking interest out. We're going to do that, right? Before we're done this summer. Okay, we're going to do it. You're going to get your first taste of it in a business setting. Okay, you probably did it in math class. Okay. Are there a lot of things in math class you did that you don't know what you did? Yeah, that's true. Okay, that's something different in college. Yeah, it takes a while for it to sink in, I think, sometimes never. Okay, anyway, what we're going to use these financial statements for is to predict those future cash flows. That's where I started with that. Well, what's your future cash flow going to be on your accounts receivable? The full amount of the receivable or the receivable less the bad debts? It's the receivable less the bad debts. So what we do is we set up an allowance. The allowance is a what? Contra asset. It represents my guess at how much I'm not going to collect with the receivable, right? Does that make sense? Okay, now, a couple ways that you could estimate that too, by the way. Oh, by the way, one other thing. Why don't we just credit accounts receivable? Why don't we debit bad debts to credit accounts receivable? We haven't lost them yet, and we don't know who's not going to pay me or when they're not going to pay me. I'm just guessing an amount that aren't going to pay me. Don't you want a list of all the people who owe you money, right? Trial balance of accounts receivable, right? Don't you want a list of everybody that owes you, all the open invoices, what means invoices that have to be paid? Sales invoice, give them a bill, right? Don't you want the total of all those invoices, which is the total of what all your customers owe you, right? All their accounts. Don't you want that to agree with accounts receivable in the general ledger? Because that's what people owe you? Sure. Okay, so why would we do that, right? But then we've got this estimate of what's not going to be paid to us, but we don't know which invoices those are. We don't know which customers they are. You got the idea? So we set up a contra account just to put that estimate in the financial statements. On the balance sheet, I show accounts receivable less the allowance. That's all we're doing. And when you read the chapter, it's like, what is this? Why are we doing all this stuff? But does that make sense, guys? Did you get your head around that? I want the bad debt expense recorded in the same period I have a sale, okay? So I'm going to make that happen. And I don't know who's not going to pay me, right? I want the allowance recorded, obviously, in the same period that I do the balance sheet showing the receivables, huh? I want the allowance to be the right number. So I show my gross accounts receivable less the allowance is my net realizable. Realizable means I'm going to get paid. Recognize, listen to this one carefully. Recognize means you made a journal entry, basically. Recognize means you put it on the financial statement, okay? So recognizing revenue means what? Put it on the income statement. Recognizing expense means what? Put it on the income statement. You recognize assets, liabilities, and equity too, right? Make a journal entry with them. Okay, got the idea? That's recognizing. Recognition. What's realization? Cash. When you realize the revenue. Not when you credit revenues necessarily, right? It's when you debit what? Cash, right? From customers. Okay? When do you recognize an expense? When you debit the expense, of course. When do you realize it? When the cash goes out to pay for it. Is that necessarily at the same time? You know it's not, right? You know how to do those deferrals real well. You know what's funny is you guys all knew how to do them really well at the beginning of the test, and by the end of the test, some of you didn't know how anymore. What is that? Very simple problems. Fatigue. Maybe. Mental fatigue. I guess you don't do that, right? We don't you work, 8, 10, 12-hour days sometimes. Depending on how to manage your jobs. Yeah. And so, you got to be able to hang in there. Okay. So just keep working. Don't let it. And maybe they got a little harder as well. Okay. So what would happen next? Let's say this is all your sales for the year, right? So we're making one big journal entry. What do you suppose would happen? They'd probably pay us, right? A bunch of our customers pay us. Let's say we collect 80,000. What would you debit? Cash. 80,000, I said. What would you credit? Accounts receivable. 80,000 sound good? Okay, now let's think about accounts receivable. I mean, we're gonna be brilliant on this one. Let's think about accounts receivable. What happened in accounts receivable? Started with nothing, it's our first year. We put 100 in here, right? And we took 80 out of here. That's the debit and the credit, right guys? And we have 20,000 left. So at the end of the year, our customers owe us 20,000. Let's see, that's the whole thing that happened, right? What do I want to do at this point? And I haven't written off any because I haven't given up on this 20,000, right? Some of them are a little slow paying by now, but I haven't given up. So it's the end of the year. What do I want to do? Establish an allowance. Create one. Get the bad debt expense recorded. Now, how would you do that? Two ways you could do it. One is you could record it. Let's put it over here. Okay. Two ways. Two methods. One is based on a percent of accounts receivable, right? And the other one is based on a percent of sales. Now, you don't really have to do a percent of accounts receivable. You could look at every single one of the accounts your customers owe you, and you can decide what the probability is of each one paying you, and you can come up with an estimate of where you think the allowance should be that way. Because the allowance represents the portion of the accounts receivable, right, that you're never going to collect. So I can look at the actual accounts, couldn't I? Right? But what a lot of people, or I could age them. We talk about aging in the chapter 2. I could age them. So the ones that are current, maybe a real small portion of those that have a bad debt allowance for doubling accounts, right? And then the ones that are 30 days past due, maybe I'd have a large percent of those. The ones that are over that, or maybe almost all of them, I think are going to be bad debts. You got the idea? So I could age them, okay, and add it up, and come up with an estimate of what I think the allowance should be. But let's keep it simple for now. Let's just say it's a percentage of accounts receivable. So one way I could do it is I could say, I think I am never going to collect 8% of those receivables, okay? That's one way I could do it, all right? And then the other thing you could do is you could base it on sales. But just think about this. And let's say for sales, what was it, 100,000 in sales? Let's say based on sales, I think is going to be 1.5%. I'm never going to see, okay, of my sales, right? I think of the receivables, I'm never going to see 8%. Of the sales, I think I'm never going to see 1.5%. Now, I want you to think about this really carefully. This is what's going to hang me up on this area. I'm doing bad debts. What account am I estimating if I take 8% of the accounts receivable? We had 20,000 of accounts receivable. What's 8% of that? 1,600. Okay. 8 times 2. Yeah. 1,600, right, guys? Yeah, you'll calculate it. Yeah, we all want. Okay, 1,600, huh? What did I estimate? What are the two things I'm on the estimate? Bad debt expense and allowance. Those are the accounts we're going to be working with, right? Oh, by the way, what kind of account is bad debt expense? Bad debt expense. Expense. It's an expense. What kind of account is allowance for doubtful accounts? Contra assets. How do you increase contra assets? Credit. How do you reduce them? Yeah, but you guys know this. Okay, how do you increase expenses? With the debt. Yeah, so we know how we're going to record the interest here, don't we? Just how much the entry is. Okay, anyway, so what am I estimating if I take 8% of the accounts receivable? Would have been 1,600.
But you're not going to get paid 1,600.
I'm not going to get paid 1,600. Which account represents the portion of the receivables I'm never going to get paid? The allowance does. You are estimating the allowance. Very good. This is an estimate of the allowance, gang. What is this an estimate of? The percent of sales I'm never going to collect. By the way, what financial statement does accounts receivable go on? Balance sheet. What financial statement does the allowance go on? Balance sheet. Pretty obvious, isn't it? That the portion of the receivables you're never going to collect is what the allowance is, right? So of course that's what you're estimating, right? Okay? If you take receivables, you are estimating the allowance. Got it, right? Because portion of receivables you're never going to collect is the allowance. Just is. Okay? Now, what if you're doing, though, a percent of the sales? The sales go where? On the income statement. What goes on the income statement with the sales? The portion of the sales you're never going to collect is what? The portion of the sales I expect never to collect is my what? Bad debt expense. What goes on the income statement with sales? Bad debt expense, not the allowance. Bad debt expense does. And bad debt expense is what? It's my estimate of the sales I'm never going to get. The cost of bad debts I think I'm incurring to get people to buy on account. Right? Because he's going to pay, she's not going to, right? And I don't know which one's not going to. Right? She's not going to. So I want this big sale to him. Right? So I'm willing to take a risk of you not paying to get the sale to him. Got the idea? Of course, it'd be, in our case, 1.5% means what? Out of that 100,000 of sales, what portion do you expect never to get? 1,500. Okay, got the idea? So you could use either one. You can't use both, right? But you could use either one to estimate your bad debts, either method. So those are the two methods. Okay, you can't use both at the same time. All right, so let's go back to this and let's do it. What do you think, guys? What would the entry look like? I've got 20,000 in accounts receivable. So let's do the first method. Okay, let's run through the whole thing with the first method. So what we're going to do is we are going to say our bad debts are going to be 1.5%, what did I say, 2%, 8%, I'll get it, okay. We think 8% of this is never going to be collected, right? That's what it is, okay? What account do I want to be 8% of that? What did we just say? Allowance. Come on, you guys. You just did good on a test, so you're going to quit thinking. Okay, allowance for doubtful accounts, right? Okay. I have nothing now because it's my first year. Everybody got the idea? What do I want the balance to be? What do you want? $1,600. How am I going to make this account be $1,600? You guys know how to make adjusting journal entries, don't you? The account has nothing in it. You want it to be $1,600. Come on, what do you do? Credit. Why is it a credit, by the way? Because it's a contra asset. Allowance for doubtful accounts or allowance for bad debts, if you want, 1,600, right? Those are the names we typically use. Debit what? See, I calculated this one, which is going to force me to make the other one. What is the other account anyway? What's it going to be, gang? Bad debt expense, yeah. Okay, all right, so bad debt expense, the other account that I'm going to mess with, bad debt expense is going to have to be what? It's going to be forced to be what? It's nothing now before I do this journal entry, right? It's going to have 1,600 put in there because debits have to equal credits, right? And I got it for the year, okay? Everybody good? That's what you do, okay? This is called replenishing, or in this case, I guess, establishing in the first place, replenishing the allowance, okay? You know what? On the balance sheet, we're going to show accounts receivable of 20,000 less 1,600 allowance. What's your net realizable account receivable? What do you expect to collect? 18,400. That's it. Does this sound like equipment less accumulated depreciation? Yeah, exactly. Got it. Or building less accumulated depreciation. Same idea. Contra account. Everybody got it? And again, why don't I take it straight out of accounts receivable? Why did I leave accounts receivable at 20,000? That's how much is owed to me, right? I'm estimating I'm going to receive 18.4. I wish I would get the whole 20. Maybe I will. But I'm trying to estimate what my bad debts are. So I'm trying to tell people the truth, right? What do I estimate my bad debt expense to be for this year? And I try to tell them, what do I really think I'm going to collect from receivers? I don't really think I'm going to collect all of them, right? We're realistic about it. But I don't know who they are, right? So I can't credit the receivable. I go ahead and put it separate allowance. All right, so that's replenishing the account, okay? Establishing the first place, or replenishing, yeah.
So no matter what, if we do the percent of the accounts receivable or percent of sales, it's always going to be debit, bad debt expense.
Yes, it's going to be the same entry either way. It's just in the case of taking a percent of the receivables, I'm estimating what the allowance should be, right? What would it be if I took a percent of the sales? It'd be 1,500, and what would that, what account would I make be 1,500?
Allowance probably.
No, it's based on sales. If I take 1.5% of my sales, I get 1,500. The sales goes on what statement? Income statement. What represents the portion of the sales I expect never to collect? Portion of the sales, bad debt expense. So I'm going to make bad debt expense be 1,500 and let the allowance fall wherever it does. If I'm estimating based on the receivables, I'm estimating the allowance, because the allowance is the portion of the receivables you're never going to collect. Got it? Everybody getting that? Okay, it takes a second. Take 12 or 3 minutes. Okay? If I estimate based on the sales, what must I be estimating? What is the portion of the sales I expect never to collect? Bad debt expense. Got it? So if you're going to take 1.5% or whatever percent times your sales, whatever your experience is in your company, in your industry, when you first start the company, in your industry, what are they usually experiencing? The same types of customers, right? What do you expect for bad debts, right? I'm going to take the portion of the sales I expect never to collect, and I'm going to make that be bad debt expense. Got it? Or if I take the receivables and I look at the receivables and guess how much of that I'm never going to collect, make a good estimate of that, what do? I make the allowance do that. Is that clear? Got it. Okay, good. Right? That's the most common mistake people make, by the way, quizzes, tests, final grade stuff. They just go to sort on one or the other of those two methods. Right? Just relax. What do you estimate? Okay? So let's go ahead with this example all the way through, and then we'll do the other way. Okay? All right. So let's now do a write-off. So this is replenish the account, right? Replenish or establish in the first place. Let's do a write-off. Let's say, then, during the next year, I give up on 1,400 of those. Okay? I give up on 1,400 of the customers. I find customers that have gone so long, and I'm calling them up, then I'm sending them letters, then I'm giving them to the collection agency. I'm just trying everything for a year, right? And then I give up. I think I'm never going to get these. It's over. Maybe some of them declare bankruptcy, and the bankruptcy court says you're not getting these, right? Or whatever, okay? Or they tell you it's over. We're not giving it to you. We're out of business. So, all right. So, it's done. I've given up, okay? I'm going to just write it off. How would you write it off? Think about this. I establish the allowance with my estimate of what bad debt expense is. Do you want to record bad debt expense again on the same ones? No. That estimate was supposed to cover people who weren't going to pay you, right? So I don't want to debit bad debt expense twice. Why would I do that? That's horrible. What am I going to do? Do I want to take it out of accounts receivable? Oh, yeah. I'm giving up. So let's do that part. So at 1,400 I expect never to collect, what am I going to credit, of course? Accounts receivable. I want to take that 1,400 out of here, don't I? Everybody agree with that? I want to take it out of there because they're never going to collect me. Sorry, never collect. They're never going to pay me. I'm never going to collect it, right? Okay, so won't you credit accounts receivable to get rid of it? If you are going to give up on the account receivable, wouldn't you credit accounts receivable? Come on, you guys. You're giving up on the asset. You don't have it anymore. What do you want to do? Credit it. What do you do on all assets when you get rid of it? How do you reduce assets? Credit. Don't start memorizing, right? Just let yourself think it's an asset and I don't have it anymore. Yes?
I have a question that's really tough on fixing.
Oh, this is accounts receivable up here. This is accounts receivable. I put 100 in, took 80 out, I had 20, and now I took 14 out. I didn't do anything to the allowance. I'm taking 1,400 out of accounts receivable. Okay, did I do it? The name was up above it. You see it? I want to take it out of accounts receivable. That's a credit, right? I want to take it out of accounts receivable because I'm giving up. So I thought people were going to pay me, or people owed me 20, and now I'm saying now they don't owe it anymore. I give up, right? So I don't tell them that, by the way.
Is this more like a random number that you picked?
No, the 1,400, well, I made it up. I found customers totaling 1,400 that I think are never going to pay me. Every time I find a customer who's not going to pay me and I give up, I take their amount of the receivable out of accounts receivable. That's all. So that's a real one. That's not an estimate. Right. Okay, so do I want to debit bad debt expense for that again? No, because my original entry for bad debt expense included those 1,400. That's part of my estimate, right? I just found some of them. So what do you want to debit? Come on, you guys, what do you want to debit? What don't I need anymore? I debited bad debt expense. What's that? The allowance. You don't need the allowance anymore, do you? Right? Because you found them. I found some of the ones I allowed for. Fantastic. That's great. Nice insight. Okay, so what I'm going to do is I'm going to reduce that allowance by 1,400 for the ones that I found. Everybody good? So it's this entry and this entry. So what I've got is credit accounts receivable, right? And debit the allowance for doubtful accounts. What did that do to my income statement, that entry? Debit the allowance. What kind of account is the allowance? Contra asset, you just reduced it, right? It used to be 1,600. If I took that amount out of there, where am I at now? 200. I got 200 down here now. Don't I? So now I got 200 down here. Everybody agree? What happened to your accounts receivable? It used to be 20,000, right, guys? Everybody agree? It used to be 20,000 here. What am I going to have now? 18,600. Okay, what was my net realizable account receivable before I made that journal entry? It was 20,000 less 1,600, right, guys? What did we say that was? It was 18,400 I expected to collect, right? How much do I still expect to collect? 18,600 less 200 is how much? It's still 18,400, isn't it? Everybody got it? What happened to my income statement? I debited a balance sheet account and asset account, and I credited a balance sheet account and asset account. What happened? What happened to the income statement? Nothing. There's no revenue or expense account there. What happened to equity? Therefore, nothing. What happened to liabilities? Nothing. What happened to assets? Nothing. You debit an asset, you credit an asset, you're still in balance. What happened to current assets? Nothing. What happened to net accounts receivable? Nothing. You reduced the receivable and you reduced the allowance by the same amount. Nothing happened. Right? That's what we want to have happen. I recorded the bad debt last year when I estimated it, right? And I reduced my net receivable then. I'm just finding ones I wrote off. So I don't need the allowance anymore, and I don't want the receivable anymore. I'm taking it off my list of things that are owed to me. That's it. Big deal. Except now I've got this situation where I've got a really low balance on allowance, don't I? So remember these numbers for me, 18,600 and 200. Oh, by the way, what happened to bad debt expense here? Nothing yet. It's a new year and I haven't recorded any. And what are you going to do with bad debt expense at the end of the year, seeing as it's an expense account, you know? I'm going to close it. By the way, I'm going to close it and make it 0. On the closing entry question I gave you, I thought it was giving you free points. About half of you didn't get that. What's the balance in a revenue or expense account after you close it? 0. What happens to all the balance sheet accounts, assets and liabilities, when you close? They stay the same. What? Look at that question. Your test. How could you miss that? Come on. You're getting tired at the end? Mentally tired? Getting jealous somehow? Yeah. So everybody missed some stuff. You know, a couple people in 95 didn't miss much. Luckily they missed something because it really makes me upset if people get 100% like that. That's a double intensity of the next game. I don't know if I've ever had anybody get 100. I don't recall that. Maybe once or something. Maybe 30 something years. But no, I don't know that. Quizzes, yes, but tests, final, certain. Okay, anyway, so you don't want to have perfection. That's like gymnastics. They used to give everybody 10s no matter what. You know, in economy, on their routines. It's just ridiculous. In the Olympics, they couldn't tell who won. Because everybody's getting the same score. They're all perfect. Yeah. Nah. Only to your grandparents, then you're perfect. That's it. Okay, anyway. let's take these numbers. Remember the 18.6, and let's do a new year. Remember the 18.6 and the 200 for me, would you? Because I won't remember in 2 seconds. So, okay. So what did I say we had? 18.6. Gave them to me both at the same time. Now you have to remember. All right. That's a joke. All right. Allowance was 200. Everybody see how we got there, right? I got another question. Could that allowance be a debit after you do your write-offs? We put 1,600 in there, right? How about if we wrote off 2,000? What would be your balance there? A $400 debit. Big deal. What are we going to have to do in our replenish the account? I've got to put 400 in to get rid of the debit balance, right? But could that happen? Could my estimate not be big enough? Of course, right? Could happen. You could end up with a debit balance. Don't let that bother you. It doesn't matter. Right after the write-offs. No big deal. Okay, let's do sales for this year. I got 18.6 and 200. Let's say my sales this year are 120,000. What would you do? All on account. Debit what? Anybody? Everybody? What do you debit when you sell on account? I think it's still accounts receivable. It was last time we did it. You guys hate me today or something. Okay, all right. All right, and credit, I only get 100% on tests. I'm mad that I did. Okay, whatever. Anyway, credit what? Sales. All right. So I got 120 coming in here. Everybody agree? What do I have now in there? Looks like 138.6. Everybody agree? Okay. Then what happens? Customers pay me. Let's say I collect some of the stuff from last year, that 18.6, right? I collect a bunch of it, okay? And then I collect some from this year too. Does that make sense? Okay? So, and then I'll have some owed to me still. So let's say that I collect 115,000. Everybody agree? Okay? Debit cash 115,000. All right? Credit what? Cash. Excellent. That's easy. You could do these. You already knew how to do these. Just adding bad debts to it, aren't it? Okay, what's my balance in the accounts receivable? How much is that? No, it's not. I added 5,000 to it. 18.6 plus 120 plus 115. Isn't it awful when you put your neck out there and say something and I just chop it right off? I want you to get used to what life's going to be like if you go into a public accounting firm. Because everybody loves to make fun of each other. And a whole bunch of smart people all working together, and they're all working really hard. What fun do you get with making fun of each other, right? So, you know, when you screw something up, everybody feels for crying out loud. Let's go. You know? So, and plus that's how you learn, of course. You know, so if I said nothing to keep from embarrassing you, oh my God, what a disaster that would be, right? You need some pressure. Yeah, enough pressure. Okay, anyway, what's the balance going to be? I add 5 to it, 23.6. Good. Let's use our same method. I got 23.6 in there. And I was pretty close, right? My estimate was pretty close. I estimated 1,600 and wrote off 1,500 or 1,400. And there might have still been some bad ones in there, right? In that 18.6. So, you know, I felt pretty good. I was fine, okay? I could be way off. You know, if I set it up with 1,600 and I wrote off 10,000, I'd be pretty upset. Everybody got the idea? Or even if I put in 1,600 and I wrote off nothing, and they all paid, and they allow maybe it's too big, right? So you can change how much you allow each year, okay? It's an estimate, right? You can change your estimates from year to year, okay? All right, so let's do this year. Let's say we still like the 8%. 8% of what, you guys? No, that's accounts receivable. Sales would be, we would use the 1.5% estimate in our little example, right? So we're going to use what? 8%, I want the allowance to be. Excellent. So take 8% times 23.6, and what do you get? That's your new allowance. What's that number? Everybody see what's going on? So after you're up and running, I've got balances of both these accounts, don't I? Right? And I just keep going. Okay? How much is that going to be? All right. And what I'd probably do is say, you know, I don't want this to look like it's an exact number. People might think it's an exact number if I, like I somehow magically know how much people aren't going to pay me. So, oh jeez, there's an undo under there somewhere, but that's not there either. I'll just write it again. Okay. So we started with 200, and I should have put it down here anyway, huh? Okay. What do I want that number to be? 23.6 times 8% was? Yeah, so we should probably round that to 1,900. I'd probably do it and say, okay, 1,900 ought to be enough on that, right? That's 8% of the amount, okay? So I've got 200 in there now. I like it to be 1,900. Can you tell me what you do? What you would do? How about crediting for 1,700? Okay, we're on our way. And it's exactly the same entry, isn't it? What am I crediting here? The allowance for doubtful accounts. Everybody agree? I do this year after year after year. I put 1,700 in there. I'm not going to put 1,900 in there, right? I don't want the allowance to be 2,100. I want the allowance to be 1,900, and it is 200. Everybody got the idea? What if it was a debit of 400? How much would I have to put in to get up to 1,900? If I had 400 over here, and I wanted it to be 1,900, what do you have to do? You got to credit it 400 to get back to zero. How much more would you have to credit it for? 1,900. How much would it be? 2,300, right? So you're forcing the allowance to be 8% in our estimate here of the receivables. So we're there. What's bad debt expense going to have to be? Notice this is always the same entry. Debit bad debt expense, credit allowance for doubtful accounts, right? It's replenishing the account. How much would that be? It's got to be 1,700. Debits have to equal credits. Yeah, that's it. Is that enough? I don't know. Let's find out when we write up accounts next year. And then we'll do the same write-off. What do I do when I write them off next year? If I write some of these off going out into... Oh, by the way, what's my net realizable receivable, I think? 23.6 less 1,900, right, guys? Could you tell me that? On the balance sheet, that's what you would show, right? 23,600 less 1,900. How much do I think I'm going to collect? 21.7, is it? Okay, good. Everybody got it? That's my estimate. How much I think I'm going to collect. And then when I write off each individual account as I find them during the year, what do I do again? Debit the allowance, reducing it, and credit accounts receivable, reducing it. Everybody formulated that answer, right? Does that make sense? I don't need the allowance anymore because I found one, so I debit it. I don't want it in receivables anymore because I don't think I'm ever going to collect it, so I credit accounts receivable. Done. Okay? Year after year after year after year after year. Okay, let's change this then. Let's use basically the same example. You'll have to tell me what it was, I guess. But let's use basically the same example, and let's run through using 1.5% of sales, huh? Okay? And maybe I'll write up a little more so we end up with a debit balance, okay? You can see what it looks like. So let's go. Give myself a little more room here. Let's do this. Receivable. And then we have bad debt expense too, right? Everybody comfortable with the debit going to bad debt expense one each year when you close it to retain earnings, right? Every year. So it doesn't accumulate, right? Okay. And net realized receivable is going to be the difference between accounts receivable and the allowance, right? Okay, so let's start with our sales. What were our sales the first time? We debited accounts receivable 100,000 was it? And we credited sales 100,000. So what's on my income statement? 100,000. What's on my balance sheet? 100,000, right, guys? So I've got 100,000 coming in here. Everybody good? We got that. All right. Then we collected 80, was it? We debited cash 80,000, and we credited accounts receivable 80,000. Okay. So now we're ending the first year here, and I've got 20,000 in accounts receivable. Everybody good? That's where we were to begin with on the other problem. Okay, so I got 20,000 sitting in this thing. Okay? Now, I want to estimate my bad debts based on sales. So I'm going to take 1.5% of my credit sales. So in my sales account, really I'd have a whole bunch of journal entries crediting sales all year long, right? But let's say the total's 100,000 in sales. And I want bad debts to be 1.5% of that. How much is that? 1,500, right guys? What are you going to debit for 1,500? What account do you want to be 1,500? Not the allowance. It will be because it's starting at 0. But what am I estimating if I take a percent of sales? I'm taking 1.5% of sales, you guys. Sales goes in the income statement. The estimate of the sales I'm never going to collect is called that debt expense, which goes on the income statement. What account do I want to be $1,500, 1.5% of sales? That debt expense. If I was estimating based on the receivables, I took about 8% of receivables or whatever percent it is, right? 5 or something in the company. If I take the percent of receivables I expect never to collect, right? What am I estimating? What represents the portion of receivables you're never going to collect? Allowance for doubtful accounts, right? And now I'm estimating the ending balance of the allowance for doubtful accounts. I am not estimating how much I add to it. The amount I add to it is bad debt expense, right? Because it's debit, bad debt expense, credit allowance. This isn't going yet. It's amazing how long it takes. Yeah. Get your head around this stuff, you guys. One more. We're going to do this every day until we get stopped getting the summer. No wonder we'll get stopped. It'll be horrible. We had to do this the rest of our life every day. Oh man, well, you only have to do it 5 years. It's okay. Yeah. Then you go to work. You could no one pay if you used to. Okay. Constantly stuff. You're more valuable than what you know. Right? It's true. Love life more fun. Okay, it's more entertaining. All right, anyway. So yeah, so what I'm going to do here is I'm going to make bad debt expense be 1,500. Everybody agree that 1.5% of 100,000 is 1,500. So I'm going to debit bad debt expense for the 1,000. Whoops. I already did. I already wrote the number down. I'm going to debit bad debt expense here for 1,500. And what am I going to have to credit? What am I forced to credit? Allowance for doubtful accounts. Now here, on this one, you're looking at it and thinking maybe, well, so what? They're both 1,500, right? I got 1,500 in the allowance now. That's the balance. And I have 1,500 in bad debt expense. So what? Let's do another year. Okay? Let's say I write off this time. So this is replenish the account. In this case, establish in the first place, right? Replenish the account. Okay. Let's do the write-off. Only this time, I think we'll write off, I don't know, let's write off 1,800, okay? What would you do? During the year, I write off 1,800 of the accounts. Debit what, credit what? What am I giving up on? The account receivable. So what do you want to do? Debit the allowance because I no longer need the allowance, right? I have 1,500 in that allowance, but I found a bunch of them. In fact, I found too much, okay? So the allowance for doubtful accounts goes down by how much? The 1,800 I'm giving up on. And where else do I want to take them out of? Accounts receivable because I'm giving up. They're not a receivable anymore. Excellent. Okay, gang. Now look where we're at. I take 1,800. Oh, by the way, what was my net realizable receivable before I did this? 20 less 1,500 is how much? 18.5, right? I expect to collect 18.5. Everybody see that? That's what would be on the balance sheet. 20,000 less 1,500 is 18.5. Okay? And then, okay, so where am I at now? If I credit 1,800 here to the receivable and I debit the allowance for 1,800, this looks weird, doesn't it? What do you have in the receivable now? 18.2. Huh. And what do you have in the allowance? A debit of 300. And when you add them together, what do you have? The 18.5. But you think you're going to collect 18.5 now? No. I think the max I'm going to collect is 18.2. I might not even get all that, huh? Right, guys? So now I record the next year. Let's go ahead and record the next year. What would it be? What did I say the sales were going to be the next year? Was it 120? So let's do the next year. It'd be debit accounts receivable and credit sales, right, guys? For 120. Everybody agree with that? That's what we did. So I'd have another 120,000 come in here. Now where am I at in that account? I have 138,200 in it. Everybody agree? True? I added 120 to 18.2. Okay? And my sales are 120, right? Sales are 120. Then I do my cash receipts. What did I say my cash receipts were last time? Was it 95 of that we collected? Oh, 115, what a memory. Oh, it was all but 5, that's right. 115 cash and credit accounts receivable, 115. Let's say that happened, okay? So what happens? My account receivable goes down by 115. Everybody staying with me? So I added to it how much? 5,000. So now I'm 23,200, right? So my ending accounts receivable before I do my financial statements, right, is 23,200 in accounts receivable, but I have 300 debit in the allowance. And you know, you're not going to do that at the balance sheet. Are you going to write down 23,200 and then add some sort of a negative bad debt thing of 300 to it and get 23.5? No, of course not. What do I want to do? What's my bad debt in this example? How am I estimating it? I'm doing 1.5% of sales. That's what I did the first year. Let's say I still think that's pretty close, okay? I think this was just an unlucky year, right? I think 1.5% is enough. I think it'll be fine. What will I do? Unlikely I wrote off more than my allowance, right? I'm only going to do 1.5%. 1.5% of what, guys? Sales. The sales were how much? 120, right? Take 1.5% of 120. What is that? It is how much? 1,800? 1,800. Okay. So what do I want to be 1,800, you guys? What am I doing here? I'm replenishing the account again, aren't I? How do I replenish the account? What account do I want to be $1,800? Which is 1.5% of 120. Bad debt expense, you got it. Because sales goes in the income statement, and what's going to go in the income statement with sales? Bad debt expense. It represents the portion of sales I'm never going to collect, right? Got it. Debit bad debt expense. Excellent. For 1,800, was it? Which happened to have been what I wrote out last night, but that's a coincidence, okay? Coincidence, that's the same number. Okay, and credit what? Allowance for doubtful accounts. Okay? And where are we going to end up if we do this? Well, let's see. I'm going to have in bad debt expense 1,800. That's what I want, right? What am I going to put in the allowance? 1,800. Ah, what's that going to make my allowance? Only 1,500. And then what you have to do is ask yourself, is that enough? What's 23,200 less 1,500? That's your net realizable receivable. It's how much you think you're going to collect, right? How much is that anyway? 21.7. Okay. What percent is 1,500 divided by 23.2? What percent do we think we're not going to collect? How much is that? What is it? 6.5. Oh, okay. What was it last year? We had 20,000 receivables and 1,500. What's 1,500 divided by 20,000? What percent is that? 20,000 divided into 15. Let's get it right. Divided by 20,000. What percent was that? 7.5. And that wasn't enough, was it? And now we're going to go down to 6. What do you think, guys? We probably don't have enough. And now we're going to use judgment. We're probably making a bigger number. Right? Probably not enough. Okay, you got the idea? So you're guessing how much your bad debt expense should be, but you're really guessing how much your allowance should be too. Okay? Maybe 8% would have been a better estimate. Huh? Maybe we should have done that approach. Use 8% here, and it would have worked out better. Because we'd have a little more allowance in each case, right? And therefore a little more bad debt expense. Got it, guys? That's it. Not a big deal. Practice, practice, practice. There's a question just like this example I did on the quiz. That's online. Work it. Make up some other ones. There are questions just like them in the homework. Work them. Not a big deal. How many of you are doing a fair amount of homework? Or actually working problems? Yeah, it shows on your test, guys. It shows. It really works. Really, for those of you who aren't, start doing it. Start doing it. Do I have to collect homework and grade it for you to forced to work. We don't want them. We want people who want to. And I don't mean you really want to get out of bed and go to work every single day and be here all day. Some days you don't, you'd rather do something else. But in general, yeah, you do. You want to make things happen. You want to be successful. You want to go after it. You got to work ethic, right? So that's what I wasn't working properly. I'm not worried about retiring. I'm in the 70s. I'm really slowing down, you guys. I probably only average 40 hours a week now at work, year round. And I take 2 months a year off. I went about 4 years without taking a vacation. Don't do that. Right? Just because I was doing it. Didn't have time to take a vacation. Stupid. Don't do that. You get yourself in a position where you can get a couple months vacation a year. It's fantastic, right? But then work 50, 60 hours a week the rest of the year to make something happen. Not just make money, make something happen. Job creators, not. Job creators are people who work. You know who the job creators are? Consumers. You buy stuff, you're a job creator. Not the person who produced it, it's the person who bought it. Is a job creator. What do you think? Who paid for it? Who paid the salary? The person who bought the stuff, right? Consumers are the job creators, not producers, right? Okay? So, get out there and produce and consume and do things for the economy. Fantastic. I prefer you made a whole bunch of money and gave it to charity. And those people can consume. Like it? That's better. Okay? But if you guys go into account, you're going to make money. Unless you go to work for a nonprofit, then I'll be more proud of you. I'll actually be proud of you, right? Make money, good deal. Okay? But if you're capable of making a couple $100,000 a year, you make $50,000 a year because you work for a nonprofit, you do wonderful things in the world, oh wow, you're gold. Those are the people that we should be giving respect to, right? Not the one the person who gets a $250,000 a year, they get $250,000, right? You don't have to give anything else, like praise or something. I don't understand this thing of we like athletes that are rich. You would think that they want to play basketball for free because it's fun. Why do they need millions of dollars to play? Strange thing in our society. I don't get it. Same with CEOs of major corporations. What do you need $2 million a year for, or $10 million a year for? What's that about? People are starving. I don't understand. Okay, well, anyway, maybe why I teach at a place like Dawn. So let me ask you this. You can actually read that, right? Sure you can. Let me ask you this. You have some questions? Or can you just do this thing? This brilliant explanation. What do you think? Did you do it yet? Okay. Let's all say it out loud. And then please mumble it to yourself. Formulate answers. How do you record a credit sale? Yeah, okay. A credit sale. Accounts receivable. Okay, debit accounts receivable and credit what? Sales. Sales. Yeah, sales is good enough. You call it sales revenue if you want. It's good. It is real sales revenue. A lot of companies do. It's fine. Okay, but you put the word sales on it. All right, we're selling product. We're selling services. Debit accounts receivable and credit, some sort of service revenue. Probably right? Charging service revenue. Okay, what do you do when you do a cash receipt from a customer? On account. Debit. Credit accounts. Debit cash, credit accounts, receivable, right? Everybody got it? That's what you do. Okay, all right. Then, what do you do at the end of the year when you want to record your estimate of the portion that customers are never going to pay you? Debit what? Bad debt expense. Credit what? Allowance. Is that true no matter what method you use of estimating your bad debt expense or estimating your allowance? Yes. Okay. If you estimate your bad, if you estimate your bad debts in general on accounts receivable, a percent of the accounts receivable, or you actually look at all the receivables and guess which ones are going to pay you and which ones aren't, that kind of thing, or you age them right, but you get this number that's an estimate of the portion of the receivables that are never going to pay you. What did you just estimate? It's the allowance. And do you want to add that amount to the allowance, or do you want to make the allowance be that number? So like when you're doing the prepaid to the unearned revenue, you didn't want to make a journal entry for the amount you want the account to be. What do you want to do? You want to make the account be that number. So what's your journal entry going to be? Whatever is necessary to adjust from where you are to where you want to be, right? It's a balance sheet account allowance. You close it every year. No, so it's not zero. So you have to look at what the balance is now. What if it's a credit? Let's say it's a credit of 1,000 and you'd like it to be 8,000. How much are you going to credit it for? It's 1,000 now. 10. 2 to get to 0, 8 more to get the credit of 8, right? And what are you then going to have to debit for 10? What are you forced to debit for 10? Bad debt expense. Yes. Got it. Okay, maybe. Okay, starting to happen. What if I estimate based on my sales? Right? Let's say I estimate the portion of the sales I'm never going to collect, some percent of them typically is what we do, right? I don't know how else you do it. Right? It's a lot of sales. You're not going to look at every invoice and guess which one to pay or not. Okay, so you've got, let's say I've got that 100,000 of sales, and I think 1% I'm never going to collect. What did I just estimate? 1,000 I'm never going to get, right? 1% of the 100,000. What account do I want to be 1,000? Sales, I estimated based on sales. What do I want to be? 1% of sales. What account represents the sales I'm never going to collect? That, not the allowance, that's the receivable I'm never going to collect on the balance sheet. Right? The receivable goes on the balance sheet, the allowance goes with it. If you estimate based on the receivable, you're estimating the balance and the allowance. Right? The sales go on the income statement. Bad debt expense goes on the income statement. So if I had 100,000, I said, in sales, and I estimate I'm never going to see 1,000 of it, right? 1%. That 1,000 is what? It is my bad debt expense. What's the balance in bad debt expense? Probably now. Assuming you're not doing monthly entries, you could be recording an estimate every month, right? But you haven't done monthly, and you haven't done quarterly either. Just once a year you're doing it, for our example, right? The balance is what now? As soon as you close all the revenue expense accounts. It's 0. You'd like it to be 1,000. What do you do to the bad debt expense? Debit it for 1,000. What are you forced to add to the allowance? 1,000. Right? You just get to calculate one side, not the other. Isn't it? So don't try to calculate both sides of the same. You can't get both, right? It's not going to work. Your debits won't equal your credits. It's a mess, right? Okay. What do you do every time you find an account? That's not going to be paid. You give up. Credit account, receivable because I'm never going to collect it. I want it off of my list, right? Take it out. Take that dollar amount out. And what have I found? Some of the amount I allowed that I was never going to collect it. So what do you debit, you guys? Allowance or doubtful accounts. That's the whole story. Okay? Go away. Keep working. And if you haven't read this chapter yet, let's go. I don't care if you took a test. Come on. Take a week off. It's only 8 weeks. It's really 7 to learn material. This last week's review for the fun. See you guys. Okay.